So this is Tax Filings 101, Domestic Filing. If anybody here is going to file an international return, there's another
workshop we hosted last week.
Oh, that was last week, but I'm guessing that it was taped, right?
Yes.
And so you can follow up with that. So this is just some fun factoids about filing and the IRS. So the IRS employs about 79,000 people, more than twice as many as the FBI. And due to budget cuts, this is actually dropping year over year, so they're not really hiring a ton of new people. The IRS is kind of relying on, artificial intelligence and bots and things called matching notices. So the IRS gets 1099. So anywhere you work, right, we'll send you a W-2, or if you have like a bank account that has interest income, the IRS knows about it. They get all of this information reported in from all the major banks and employers that are registered with the IRS. And what happens is that they'll get your return. It'll be digitally read because most of you will e-file, right? Then they're going to see what's on your tax transcript. And those two don't jive. They're going to, it's called like a CP2000. It's an error that throws up an automatic red flag and immediately sends out a notice. So always report everything you know about. A lot of instances, banks won't report income if it's under $10. So say you have $100 in a checking account and it's interest bearing. The IRS probably doesn't know about it because it didn't get reported from the bank because it produces less than $10 in a single year. Over 101.6 million tax refunds worth nearly 281 billion were issued for 2017. The average refund is $2,771. Now, I'm sure if any of you read or check CNN, MSNBC, CNN, whatever it is, you'll notice that a ton of articles have been out there lately about tax reform, which we'll touch on here in a few minutes, and how tax refunds have actually gone down. Now, tax refunds are going down because the total amount of withholding that was coming from your paycheck went down, right? Because of the Tax Cuts Jobs Reform Act of 2017. They got rid of personal exemptions. Again, we'll touch on that in a minute. But it kind of went a little wonky with how we were going to withhold from payroll. And because of that, since there's less withholding, because there are no longer exemptions, refunds are down. Now, I know that sounds terrifying, right? You rely on that refund, but I look at it this way. You got more cash in your pocket week to week. I personally like it. So every year when I generally end up owing like $1,000 between Fed and state, and I purposely do it that way. I used to put my exemptions up to 3 on my W-4, so I would consider me, my wife, and my fictitious child. Just so that they would withhold less, so I would have more money in my pocket, week over week, month over month. So even though tax refunds are down, there's still the same amount of money in your pocket. You're just not getting it in a lump sum on April 20th, which again, not giving the government a no-interest loan for 8, 12 months, I'm okay with. So e-filing is now nearly universal and mandatory in some states. For instance, Massachusetts requires that you e-file. The Fed doesn't necessarily require that you e-file just yet, but again, you get your refund faster, it's easier, and in certain situations, I don't know if you've seen the free commercials. I don't know who does it, H&R Block or Jack Lee, one of the two, or one of them. It's free in a lot of states, in the Fed. So, yeah, they usually are filed by May 5th, and most of them are electronic. So, May 6, 2017, the IRS identified 195,000 fraudulent returns claiming $2.1 billion in tax refunds. This happens a lot. Fraudulent refunds happen to my clients quite a bit. I work in the high net worth individual practice at PricewaterhouseCoopers, so working with people who have like private jet problems, not normal people problems. And a lot of the times what will happen is that a fraudster will get a hold of their social security number and file a zero return and just try to get that refund back as much as they can. They don't care really about the reporting accuracy or anything. They just file a return and hope they can get the money, whatever it is, back. And this is becoming much more common than not. So just be sure, if you ever suspect yourself that you've been a subject of identity fraud, the IRS will issue PINs. You have to fill out a couple forms, and it's like an identity protection PIN. I highly recommend doing it if you've ever been subject to identity fraud. Largest major tax reform was in 1986, and this past one was just in 2018. So this is a funny cartoon. How about I give you a little, you give a little, you come up with something no one likes and call it a day. This is probably the definition of compromise, right? Nobody leaves the table happy. I think corporate tax cuts would have made a few more people happy in this situation, but leave that for another day. So here's what we're going to talk about. We're going to talk about 2018 individual tax reform, filing methods, 2018 individual tax forms. Again, with tax reform, they're going to look funky this year. You might be used to like an EZ or a 1040A or something that looks very formulaic, because you've seen it since 1986. Like the forms really haven't changed since then. They're going to look funky. Big white spaces for no apparent reason other than to just condense it. I tried to do my own taxes and it threw me for a loop for about 20 minutes. Where do I file if I live in one state? Income, adjustments, deductions, individual tax rates, credits, AMT, and we're going to touch on tax reform just one more time so you guys kind of make sure we touch on what we touched before. All right. So, and I think, does everyone, I think we'll post the slides, right?
Should be the last page on your thing.
Okay, cool. The last page of this goes through, of this handout, kind of goes through the nuts and bolts of things that are going to impact you, right? If some of you have a lot of state taxes you pay because you have real estate taxes, does anybody own a home? Own a home here? Anyone? Okay. Pretty much you're going to be fine. Anyone make over like $250,000? Because then your state taxes will probably be above $10,000. Okay. No one's going to be limited here. So the biggest impact in a lot of these, and you won't see it here, it's probably in the next page, is that they limit state taxes to $10,000, which for most people isn't a big deal. State taxes includes personal property taxes paid on vehicles in Virginia, state withholding done under W-2, real estate taxes paid. All that is considered state taxes. If you get alternative investment reporting from K1, sometimes they pay taxes on your behalf. Those are all state taxes. But, so capital gains, qualified dividend, anyone here have brokerage accounts? Nothing really changed. Same as prior year, it's 20% as a maximum rate. Standard deduction, this changed. So these two will touch and impact each of you. So if you're filing your own return, this year the standard deduction went up from, last year was $6,500. This year it went to $12,000 for single files and $24,000 for joint. And then, it's a little bit different if it's head of household or, married filing separately, things like that. So from $6,500 to $12,000. But what they got away with, what is no more, are the personal exemptions. So last year, you got both of these, right? If you claimed yourself on your own tax return, your parents were claiming you as a dependent. So you got both of these. So you got about $10,000, $10,650, something like that. This year they upped it a little bit for you, right? They got rid of 2, went to a simplification of 1, okay? And if you're a joint filer, it's 24. This helps people who don't really own homes, right? This makes it more of a middle America aspect, right? Because if you don't own a home, you don't get a mortgage interest deduction. You don't have real estate taxes paid. So you're kind of sitting there with, $6,500 or $13,000 if you're married filing jointly. It really doesn't help you that much. But now they upped it to $24,000. That's a little bit more of a help, right? For middle American people. So watch for that on your tax return. You're not going to see, $6,500 and $41,500. AMT, most of you won't even have to really worry about AMT. On a tax return, there's actually a couple different taxing regimes that all come together. You have your regular tax, which is done on tax tables. Then you have AMT, which is alternative minimum tax, which is supposed to help kind of equalize the tax playing field back in the day when people were earning a lot of passive income and they didn't have deductions. And basically, it's that whole Warren Buffett idea that my secretary has a higher tax rate than Warren Buffett, right? AMT was supposed to solve some of that. It really didn't. But basically, AMT recalculates your entire tax and removes deductions and tries to tax you at a higher rate. It's getting even harder to get into AMT now because they've gotten rid of some deductions. And I know I'm going kind of fast. I think AMT is one of those things you can kind of just forget about for now. Capital gain exclusion for primary residence. Anybody selling a home? No? Okay. We're going to go ahead and move on from that. All right. Itemized deductions. This is what we were talking about earlier on that first page. So if you use this, right, most of you will take the standard deduction. Now let's say this year you had $100,000 in charitables. Then you'd itemize. You get to pick either or, not both. So itemized deductions means you're going to take like all your charitables. Maybe you have 3 or 4 homes that you pay mortgage interest with. You'll get to take that interest, and that all adds up, so you itemize instead of taking the standard deduction. That makes sense? All of you, including myself, will take the standard deduction. Right? All right. No. So there used to be some small limits on this, like a 3% limitation. There's really nothing that's being limited much anymore. They got rid of some deductions. Itemized deductions will not touch any of you. So just remember, standard deduction went up, and everybody's happy with that. Okay. State and local taxes, as I mentioned before, they chopped it to $10,000, not $10. They chopped it to $10,000 for single files, or $5,000 for single files and $10,000 for joint. Mortgage interest, there were some limitations done on how much original indebtedness you can have versus, HELOCs, which is home equity lines of credit, things like that. Don't even worry about it. Charitables, if you're extremely charitable, you can now give up to 60% of your AGI. The IRS hasn't issued any regulations describing, so it used to be up to 50%, they bumped it an additional 10, and there's no word on whether or not that has to be cash or property. Is anyone going to donate 60% of their AGI this year? I know I'm not. Right? So don't worry about that, just let you know. And miscellaneous itemized deductions, that's no more. So you used to be able to itemize things like brokerage fees, accountant's fees, things like that were itemized, or things like that that you incurred just in the normal course of doing your own personal business. You can't do it anymore. So, I know I'm kind of quick, but that's tax reform in a nutshell. There's a whole series of other stuff that happened in tax reform, but these are kind of the areas that are going to touch you guys. Baseline, your standard deduction went up. So as long as you remember that, everything's good. I'll hand over to Malia.
Thank you.
Yep.
Thank you, Paul, for explaining all the...
You want me to run the control for it?
Oh,
Sure.
okay, before we talk about how we can file our taxes, first I would like to go through our handout. The first page, the tax equation. This is a summary of the form that where we can find like our income deductions, or the credits that we are going to get, or taxes, where on the form they will go. First of all, the total income. So if you, the tax equation is in a way that first we will enter all our incomes, list all our incomes, and the total incomes will go on. Okay, I will show you later on the form.
Yeah, so you can use this as we're going through.
Yes.
This is kind of like a reference, like big picture. This is how the tax is calculated and the schedules. And so Paul referenced how the forms changed quite a bit this year. So we actually printed them out for you, and that's the next few pages. So that's what the tax form actually looks like. So that's page 1. Paul said there's like a lot of white space. You'll see like all this was just blank.
They're still printing the whole page. The half of it is just white though.
I think it's trying to make it look more like a postcard. I don't know if you've heard that before, but this will just show you what it actually looks like. And then the next few pages are schedules. So you'll notice on page 1 I will reference like Schedule 1, Schedule 2, Schedule 3. So this is just high level. You can see where it flows on the return as we go through these items.
Yes, like on the tax equation, income, and then we will deduct our deductions, and then we'll come up to our AGI adjusted gross income, and after that we will deduct our either standard deduction or itemized deduction, the one which is higher, and we will get our taxable income, and then we will multiply that by different tax rates which are available for all the different filing statuses, and then we will deduct our credits, then we will get our total taxes, which can be either tax refund or we owe to pay our taxes. So
I'm curious, has anyone, who here has like filed their returns, or who here is just completely new and has no idea what? Has anyone filed their returns before? You have?
Yeah.
Like,
But I've switched from the W-2 to like an I-9, so I need to know what to do with an I-9 now.
To 1099?
No, a 1089, I think, T. It's like a,
okay,
I thought 1098T.
yeah, 1098 T.
everyone else pretty new to filing their returns, like not very familiar?
So that, yeah, this is actually really helpful, right? We have a small audience here, so we can really cater to your guys' questions, right? So it sounds like there might be some W-2s in here, right? Earnings from having a job, some wages. What other sources of income do you guys have year to year?
Scholarships.
Scholarships,
Yeah,
good.
we'll touch on that.
Yeah, what else do we have?
Fellowship.
Fellowships, maybe some bank interest from a bank, maybe. If you have that, you'll see that on the 1099. Right? So like what you're sharing are very typical sources of income. And this doesn't surprise me, right? So generally the tax law, right, as a general matter, will say all income is taxable. That's just your starting point. Then the tax law will provide exclusions from the general category of everything is included. Right? Then the tax law will provide deductions for certain things. And the tax law will give you a baseline deduction, a standard deduction, as they call it, right? To reduce your income. And then after your deductions, like Malia said, then they're going to say, all right, that's your taxable income. Right? And on your taxable income, you're going to be assessed tax. Right? And the actual tax rate will depend on how high your income is and what filing status you are. Right? A single person has a different tax bracket, if you will, than married filing joint. And then there's some special things that we'll also be able to talk through during this presentation. So we have some special credits, tax credits, that will probably be of interest to you. So there's some education credits that are really awesome. So we'll talk through that. Right, but that's the general formula, right? So like, there's a lot of material here and it's really easy to get lost in all of this stuff. Right? But that's where we want this to be interactive, right? Because we have a really nice small group here. So please chime in, pause us if you hear things that just straight up aren't relevant to your situation, because we want this to be of the most use to you guys. And again, like we printed the forms as reference because even for us as tax professionals, so much has changed that I was actually joking, saying this is actually a really helpful presentation for me because guess what? I have to file a 1042, and these new forms look completely different from what I'm used to. Right? So that's why, like all of us are trying to get used to these new forms, these new rules and schedules. So is that helpful? So is that tax equation helpful? You can always refer back to it, but that's, whether it's the old 1040 or the new 1040, that's the tax equation.
It's the same overall like
Yeah.
calculation, but just the presentation on the forms is all different.
There are more schedules this year.
Yeah.
Okay, thank you.
Someone has a question.
Oh.
Yeah.
Oh, wait, I forgot your name, but when you
Yeah.
were presenting, did you say something about like itemized deductions being eliminated this year?
So,
Personal exemptions.
yeah, personal exemption.
Okay.
Yeah.
Yeah, no, the words are stairs, I used to get those confused all the time. Yeah, so that used to be a really nice deduction that each person would get, you know, for being alive.
Yeah, just for the benefit of being a human.
For being a human, right, you can be an animal, but if you're a human, right, then the tax law permitted, this is in the past, permitted a deduction per person, right? So ballpark $4,000,
Yeah.
right? And so if I file my own tax return, this is the old law, right? Then I would be entitled to a $4,000 deduction just for being alive.
That's
then
in addition to the standard.
In addition,
Oh, in addition.
in
Wow,
addition to
okay.
the standard
Yeah, it was
deduction.
this point that we were talking earlier, the exemption which does not exist anymore because of the new tax
Yeah.
law.
But like I said, with the increasing of the standard deduction this year to 12,000, you benefit because even though they got rid of the personal exemption plus the prior year standard deduction, right, wasn't equal to 12,000. So this year you benefit because you get an extra like $1,000
Yeah, I
of
see
income
that.
that will be subject to tax.
Yeah, and so something just to keep in mind, because if you're having conversations with your parents, this might come up, right? So under the old law, this personal exemption that each one of us was entitled to could either be claimed by us as individuals or by your parents, right? If certain rules are met. And so I know going through school, my parents claimed me, right? Like they paid for all of my living expenses, right? And so they argued that it was their deduction that they were able to take on their 1040. So if they took my deduction, then I couldn't take my own deduction. So in the old law, that was some coordination that was required, particularly for parents and students, right? Now, after I got more established on my own, then they could not take my deduction, right? I owed my own money, that was my deduction to take. Now, even though the standard deduction is significantly higher, which is wonderful, right? But with the personal exemptions now gone, it no longer gives parents the ability to get a tax benefit for the fact that you're alive, right? That's what the
If they have
exemption
if they have multiple children, you get an exemption for each one
in the past,
in the past.
Little
right?
baby tax shelters.
Yeah. Yeah, so that's a big difference now, starting in 2018.
Okay, sorry, I think I'm having trouble understanding. So, like, they still can claim you as a dependent, or whichever the framing is. They just can't get your exemption? Is that what I'm hearing?
Yeah, so, yeah,
Yeah, the question's gonna be, can anyone claim you as a dependent? Right, and that's if they provided more than 50% of your living expenses for the year, they lived with you for 50% of the year, things like that, right?
We'll go through the actual rules.
There are
uh,
our presentation will cover all those in detail.
But it's not gonna matter anymore, right?
But the deduction, like associated with claiming someone, is gone. So really, like we were talking, like what does it matter if you're claimed by your parents? There's no exemption anyway. So
I don't even know if there's anywhere on the new forms now where they indicate, is there?
Yeah,
Where
so
they indicate?
if you look at page 1
yeah.
of
All right,
the,
Yeah.
well, let's take a gander.
you'll see there's that
I
section.
see we're asking because we don't even know these forms, right? They were just released not too long ago.
There's a section. So page 1 is just like information. And page 2 is where you enter like income expenses. So page 1, there's a section for dependents right there, kind of in the middle. In the past, if your name was there as a dependent on your parents' return, then there was another spot to the side where it added up the total exemptions, and then you got that times $4,000 or whatever. But now there's no deduction associated with being a dependent. So
It's just
I guess
informational.
it'll affect other things like the child tax credit or,
What's the credit for other dependents?
but anyway, does that make sense about, do you have any follow-up question with that?
So it doesn't hurt you if your parents claim?
I don't think so.
Okay, all right.
In the past, it
If you
would,
still- Yeah.
and that was like, I know I kind of argued with my parents because I was
So did
like,
I.
I pay for my own school.
Yeah, okay.
Like, don't claim me because I want to claim myself. But now I don't think it matters because there's no exemption.
Do you really want to mess with your parents though? Just go ahead and file your own return and don't tell them, because then the return will get rejected immediately. Like, it's a lot of fun. Sorry to take over your portion. Go ahead.
Yeah, if there's any more questions?
Yeah, jump in at any time. Yeah.
Yes. Okay, now we're going to talk briefly about how we can file our returns. There are two different types of returns. We can file either send our return by mail or electronically filing. We can find there are like TurboTax or other softwares online on the IRS website. You can find most of them cover like a federal return for free, but some of them might cover the one state return as well. And the payment methods that we can pay our taxes are by check, direct payment, or debit and credit. Another big changes that we noticed in 2018 is that before 2018 we had three different types of 1040 forms, like 1040 Easy, which was the least complex one. It was very short. People could itemize their deduction, and it was used only by single or like filing separately, married filing separately, two filing status people, and their income had to be less than 1 million, and their interest income had to be like less than for like $1,500. And the second one was 1040A, which was used by the head of household as well. They could claim dependents, but this is also less complex than the 1040. 1040 was the standard form used by everybody, whoever could itemize the deduction or they used the standard deduction. But this year, we only have the 1040. That's why the forms have been very brief and everyone can use it. It's not very complex to put a lot of schedules or a lot of information if you don't have income from different sources.
I think this is part of simplification. Now there's only one 1040 to choose from, right? Before there was confusion. Do I use a 1040A? Do I use a 1040EZ, right? Now there's just one 1040.
Anybody ever filed 1040 easy? Anyone? I personally never filed, even when I did my own stuff, like when I was a student, I never filed an easy, never once. I just used 1040.
Well, now you have to use the
I think
1040.
using TurboTax one time, I just did it automatically.
Automatically.
Does anyone use like TurboTax? Like, how do you file your returns? TurboTax?
I use
I
TurboTax.
use TurboTax.
So
use
it might
TaxAct.
have defaulted to the easy, like without you even realizing it, just because it was a simple return.
It's worth the like 30 or 40 bucks.
TaxAct did it for me on the schedule, on a
Or
1040A.
TaxAct, yeah, same
They
thing.
did it on the schedule, a 1040A for me.
So now the idea is that with the new format, the page 1 and page 2, if you have a simple enough return, you just file page 1 and 2, and you don't have to attach the
Return is on
schedules.
a postcard.
And it's a postcard
Right.
return.
Ted Cruz is super
So
excited.
they just got rid of 1040A and easy altogether. Everyone's gonna file 1040. That's the bottom line.
Okay, the next question will come, who should file their tax returns? Any individual whose income is equal to or more than the standard deduction. For example, if you're single, it is 12,000. If your income is 12,000 or higher, you should file your taxes. And there is additional standard deduction for the people who are above 65 years old or who are blind. We'll talk about that later. And the due date for paying your taxes and filing your taxes is April 15th, but there is an extension period of 6 months. It is only extension for filing your taxes. It's not for paying your taxes. The payment should be made by April 15, 2019. Otherwise, there will be penalty over your taxes. And for extending your returns, you can fill Form 4868. And for the people who live outside the United States, they can get an extra 2 months of extension, which will be, the deadline will be December 15th for those people. But yeah, April 15th is the deadline for paying your taxes and try to file your taxes by that date.
What's the difference between like filing and actually paying?
That's a good question. Filing your taxes means you are filling the forms, and if you owe to pay extra taxes, you will make the payment. But if you are over to, like, you get a refund for that. But paying your taxes is if you have to owe the money, you have to make the payment. Like, filing is paper filing, but paying is if you owe the money, you will pay the government.
Always think about it this way. Everything's due on the 15th. All the money that Uncle Sam wants, you have to pay by the 15th. But that doesn't necessarily mean you have to finish filing this form until October 15th. So in a lot of instances, we'll extend clients because they receive information from businesses or corporations that haven't finished filing their returns this year, right? They extend, so our clients have to extend. This happens a lot with alternative investments, I'm sure. Some of you may have heard of things called hedge funds. Very complicated stuff. Jen loves them. Levi's getting used to it. They're extremely complicated, right? And they have books from everything. They own anything from oil and timber to, you know, just raw land, just random stuff. And they put it all together, right? And a lot of these don't close their books until, call it, you know, August or in the summer. And so what happens is that we have to extend those returns, we have to extend our clients' returns. So the difference between filing and paying is just paying what is owed to the government. Filing is signing your name on the bottom of that form to penalties of perjury that you've actually reported everything to the best of your knowledge on this return, on this form. That's filing. Does that make sense?
Yeah, it does. So like you're almost estimating how much you paid.
It's exactly what we're doing.
Yeah.
I always say we're just trying to get to the ballpark, sitting in the stands. I never want to get all the way around until, you know, October 15th.
So, okay, and then that's what like a tax return is. It's like, pretend you overpay and then they give it back to you, is that
Right.
it?
That's right.
That's the reason.
And then is there any instance where, you know, you underpay, it'll be like, oh, you still owe us some money?
This guy. I owe every
So,
year.
if you're in that position and you extend, and then when you actually file later in October and you still like owe money, that's where you'll have a penalty because you should have paid that balance.
A little bit of penalty. Underpayment penalty is 5%.
And that's where you have to do a little guesswork, and a lot of people will just like overpay a little bit just to make sure they're in the clear. Because the problem is you don't know exactly the final numbers in some cases at April 15th, so that's why you extend. But I think like a good point to make is if you like are an employee, your employer withholds for you, right? So you don't have to make like a separate payment to the IRS because they withhold on your behalf and pay. So this doesn't really like affect a lot of people, but if you like own your own business, there's no one withholding for you. You have to pay taxes throughout the year quarterly to the IRS. And that's where you'd be in a position where you kind of have to estimate and make an active payment. Do you have a question?
Yeah, is that the same for federal work-study jobs?
I would imagine they would withhold.
No, work study should be in W-2, right? You should have got a W-2 from your work study. I mean,
Yeah.
that's what I did when I worked at whatever
So
school.
the school will
They'll
withhold
withhold
for
it. You're just a W-2 employee. You fill out your I-9, you fill it.
Yeah.
For the 1098T, they report like what they pay to the school for you, and then they report like some other like number that they give you, but they don't actually talk about like this stipend. So should you be paying tax on that quarterly, or is that something that you'd end up paying when you file the
So
return?
we'll hit on scholarships, tuition. I think that's your section, or you're talking about scholarships and tuitions?
Yeah.
Jen, somebody. So in most instances, scholarships aren't taxable unless they're used for non-qualified tuition-related expenses. So if you're receiving a fellowship or a scholarship, most more likely than not, Jen, somebody correct me if I'm wrong, I haven't done this in a long time, but they're not going to be taxable unless you're using it for like you get a scholarship and you go buy a car, right?
What's your situation? Like, what is the
So
scholarship?
I have like a fellowship that pays for, I'm a graduate student, so they pay for like the tuition for like where I'm at now, and like other fees like health insurance and stuff.
Yeah.
And then they also give like a stipend.
Most of that's going to be non-taxable.
Okay.
Because, and this was part of tax reform that they were going back and forth with, and in a lot of research institutions like MIT, Caltech, they butted against this. What they wanted to do was actually make that taxable to fellowships, but it never passed through tax reform. And so these fellowships, because you're basically receiving the education and you're working as part of it, it's going to be non-taxable. We can talk specifically about this after, like your very specific situation. We're happy to help you through it. But most likely it's not taxable.
Yeah, that was a big thing because a lot of graduate students, they go and then they receive like a large stipend or whatever. And that was but they're not like working, they're going to school.
Well, they're working and going to school. Like it's a tit for tat there, right? Like,
Right, but you don't have like other income coming in usually, right?
Yeah.
So that would have been taxable to them, which is like a big deal for graduate students that, go do a PhD or something. So it ended up being not taxable to most of them. Big deal.
As we discussed earlier about the Form 1040, the first page contains all the personal information. The filing status, we have 5 different filing statuses. Your information, your name, last name, social security, if you have any dependents. Here you will add your information and sign. And here, if someone else prepares your returns, they will sign this section. And then on page 2 of the 1040, it contains all the information which is on the tax equation, which summarizes this very well. Here you will enter all your wages, income from whatever source you get. And then your above the line deductions, adjusted gross income, standard deduction or itemized deduction, the higher of the two. And then you will add your credits, then you will come up with your taxable income multiplied by the different tax rates, and then finally we will get the amount we owe or the amount which will be refunded to us. by the government. Okay, here on the 1040 we have 5 different filing statuses: single, married filing jointly, married filing separately, and head of household, qualifying widow or widower. The standard deduction for single and married filing separately is 12,000. Married filing jointly is 24,000.
Anyone
And
married?
head of household is 18,000.
Married, so you'll be generally filing jointly, right, with your spouse. If you haven't filed already, you might want to toggle between married filing jointly and separately. I actually did that on mine, and it worked out to be better filing separately.
I got questions after though, I got questions after.
All right.
Okay. Do you both work full-time?
Both work full
So
time.
that, yeah.
It might help. Just in some instances, you can file jointly Fed and separately. So DC is a jurisdiction where you can file jointly on the Fed, but separately in DC.
Okay.
And you can sometimes toggle between the two. And that's kind of like a little tips and trick thing. So play with it, see if it works. It worked better for myself, but
We can ask.
everybody else is single? Alright. No one head of household or had a spouse who passed? You're all going to be filing single. Except for you.
There are some requirements for filing as a head of household.
Let's just skip this. We're working on time here, right? This is an hour. No one's head of household. Sorry, don't need that.
We don't need that.
Keep it moving.
Okay. This is a question which crosses our mind mostly. If we are working in one state and living in another state, for which state we have to file the tax? Actually, the thing is that we will definitely file for the state where we are living, and then if the employer withholds some money for the other state where we are working, we will file that state as a non-resident. If not, then mostly we will file the resident state's return. For example, if a person lives in DC, he or she will file the form 1040D40, sorry. And yeah.
Does anybody work in DC but live in Virginia? Okay. Or live in Virginia and work in DC, or work in Maryland and live in DC, or live in DC or Maryland. Any of those stuff, okay? Right? The tri-state area has a nifty little thing that if you live, right, where you live in Maryland but work in DC, DC is going to withhold from Maryland taxes, right? They're not going to ask you to withhold DC taxes because you don't live there, and it becomes a pain. And you got to file a DC return to get a refund because you don't actually live there, and then you got to file a Maryland return because that's where you actually live. Because your place of residency will generally, what you are considered a resident, will determine the situs of where you're going to file your tax return. So, for instance, I live and work in Virginia. I'm very simple, but I might one day live in Virginia but work in DC, right, at a different firm, for instance. That firm will still withhold at Virginia taxes because they realize that people commute a ton in this area, right? Traffic's horrible, everybody knows. And so because they know this is a very commuter-based area, they're not going to withhold in DC or Maryland if you live in Virginia, or whatever permutation of that you want to create. Does that make sense?
So
Son? Oh, go ahead.
So you have to file in both DC and
Nope, hopefully not.
That's
Hopefully,
like the typical.
Because that's what I've been doing. I've been
So-
filing in DC and Virginia.
tell your employer where you live.
It depends where they withhold, right?
So-
Yeah.
Well, because sometimes I work in Virginia like over the summer, and then
Okay.
at school I work in DC.
That happens. Sometimes you have to file a second return. So I had a friend who forgot to switch his residency on his W-4 and had like $40,000 of withholding in DC for no apparent reason, but lived in Virginia. So I think the form is a D30. Like if you live in Virginia but work in DC and they accidentally withhold DC withholding, you file the DC return and they send you the refund. Or you file your Virginia return saying you're a DC resident, you get a refund for all your withholding. Basically, if that mistake does happen, you're a DC resident, but you've got Virginia withholding or Maryland withholding, just file that second return. It's a pain, but you'll get your money back.
Yeah. Question.
I went to New York first year, and I worked both here and in New York.
Fun.
To New York and DC.
Does DC withhold? Check your W-2, right? You I would generally say you're not considered a DC resident because you're a student. In most situations, they don't say that a student is a resident. A resident becomes a person who has all intentions of staying in that jurisdiction for the foreseeable future.
It has a driver's license.
Right.
It's established.
It's a multi-factor, fact-based test. Like, it's very hard. So what I would say, if they're withholding DC, and on your W-2, your W-2 is gonna look, you know, everybody's seen the W-2, they're gonna have 100 little boxes, but on the bottom of the W-2 down here, they're gonna list their state. Yours, being a New York resident, will likely say DC here, then it'll list the income amount, and then it's gonna list the tax amount. If this says DC here, you're gonna have to file a DC return. Now, in most cases, I forget what the filings amount requirement is. Every state has a filing amount requirement, so in Virginia, I think it's $10,000. If you didn't make more than $10,000, you don't have to file a return there. If you don't have that much cash in New York, or you're required to file a return, then you can kind of just go on unless you want to get your withholding back, which I would recommend.
Get the refund back.
Right. So yes, you'll probably have to file a DC return and a New York return and a federal return.
Yes, on the form W-2, it will be mentioned for which state you have withholding balance.
And my guess is you probably got two W-2s. One from New York that shows New York down here, right? And because you're a New York resident, you actually technically have to report both of these amounts of income to New York. Does that make sense? But you would only report DC income to DC. I hope this is okay, it is good. Does that make sense? So you will likely have 3 returns, DC, New York, and Fed. All income gets reported to New York, because that's how residency works, right? Your resident state requires you to report all income, just like your Fed. Think about Fed in your home state, it's pretty much the exact same thing. All income goes there. But if you have a rando state like DC, it's just the specific rando state income that gets reported there. Does that make sense? Give me the face of kind of. Are you sure? Are you sure? Okay. Sorry.
Okay, qualifying dependents, since nobody has.
Yeah, these are like the technical rules for how you would either be a qualifying child or a qualifying relative. In the past, this was kind of a big deal because you're like trying to barter with your parents, right? Now there's no exemption connected with these rules, so you can look them up. They're pretty easy to understand. It's like how old you are, where you live.
Okay, income. Which items can be considered as an income to report to the government? First of all, for your wages, you will get a W-2 from your employer. If you have interest income from your, like any bank or savings, then you will get 1099 INT form. For your dividends, 1099 dividend scholarship or grants, if you have. Then sometimes, Levi will discuss this in detail. Some scholarships might be taxable, but a lot of them are not. Depends on the situation or the service that you provide. Do you get like other wages as well besides the scholarship, or no, it is only the scholarship? Depends on the situation. The retirement plan, capital gain or losses, Schedule B, and tips, gambling income, business income. Business income, which will be reported on the Schedule C and Schedule C easy. If you have a farm and getting some, making some income from your farm, you will fill the farm Schedule F and report that onto your 1040. And then rental income, which goes on Schedule E, and then the total amount will, of course, will be reported on 1040. And flow through business entities, which can be from LLCs, like partnerships, S corporations. And also cancellation of debt. If you have a debt and you provide service instead of paying the debt off, then that can be considered as an income as well. So money coming from any source will be considered as an income and is taxable. But if you receive any property instead of the service you provide or the goods you provide, then that should be considered as a fair market value. Okay, now I would like to.
Airbnbs are a fun thing, right? They're technically considered a rental, a short-term rental, and it's actually being hotly contested in a lot of jurisdictions on how to tax an Airbnb. But yes, technically it is income, and depending on how they actually rented the Airbnb, or they give you cash, or it's through the app, or however, it can be kind of odd on how it's reported. Airbnb, though, should, if it's purchased through the app, should be issuing a 1099 with rents and under rents and royalties under Box 1, if you want to be super specific. But yes, it is technically income. I do know some crafty Airbnbers who, tell the people who come to rent their things, don't pay me through the app, pay me cash, and they don't report it.
And there's the number
That's illegal, by the way.
number of days.
That could be our secret. Go ahead.
Where would freelance writing fall in that?
Like a Peter Parker.
Like you get paid, just like
1099
like
would be a
one-
miscellaneous income. It would go under line 21. However, what I would recommend is that instead of doing line 21, depending on the amount, you can always put it to Schedule C and say, you're doing business as, I don't know who you are, Peter Parker Industries, right? Peter Parker was a freelance photographer, right? And you can then take some deductions and try to chip away from some of that income. So freelance writing would generally go under miscellaneous non-employee income, or, you know what I mean, because it's a 1099 miscellaneous. But I would take that 1099 miscellaneous, drop it onto your Schedule C, and see if you can't get rid of some of that income through deductions, right? So because maybe you bought a camera, maybe you have to get Ubers to go to your freelance writing, or you know what I mean, or whatever you had to buy, right?
You keep saying line 21, it's not.
Oh, no more line 21.
Wait, I think it is.
Is it?
You have to specify, it's now Schedule 1. Like
Sorry,
Schedule 1.
I'm using the old form. In my mind, it's line 21. I'm really sorry about that.
Okay, no, I think it's still.
It is, it's
21.
Schedule 1, line 21.
It's
My
still line
apologies.
21.
And what do you mean by
Schedule.
schedule one?
So,
If you look in the packet,
in your packet, there is, this will be on it. So, page 1 and 2 are just like the
like cover page.
yeah, the cover pages. All the partying and the tax return is always done in the back. All the schedules have all the fun stuff, right? Just the simple stuff is reported on page 1 and 2. And I'm sorry if we a lot of this stuff we forget about because we're so deep into it. But Schedule 1, right? Schedule 1, sorry. Schedule 1 holds a little extra partying. It tells you about additional income. So taxable refunds, alimony, business income or loss from Schedule C. That was what I was talking about before. Capital gains and losses, reserved for other stuff. So when the IRS doesn't know what they're going to do with stuff yet, they put reserved. And what I was talking about, generally miscellaneous income would go under line 21. But in your instance, since you're doing freelance writing, technically writing would qualify as a qualified business activity. I forget what it is, what the code would be under Schedule C. What I would do is move this from line 21 and put it underneath 12, fill out Schedule C, and see if you can't be legally creative on the deductions you would take against your income.
Do you spend a lot of money as part of that job, like cost of maybe a computer, or I don't know, what do you spend
For
on?
a computer, yeah.
Sure.
Like you have to buy a computer to write. I don't know what else.
Maybe you buy pens or extra special markers, or I don't know.
Maybe you have to drive to the whoever's paying you or hiring you to drive back and forth.
Right.
The cost of driving.
An Uber, things like that. Think about the normal cost of doing business when you freelance write. Those would likely be deductions you can take against that income.
That's the benefit of Schedule C, is you can net it with some costs. If you put it on line 21, it's just like you're reporting the whole income, there's no deduction.
Buy TurboTax. Use TurboTax, right? And then use that. There's a business section for Schedule C. Use TurboTax, and it'll help you figure all that out. It asks you a bunch of questions for anyone who has ever used TurboTax. A bunch of interview questions, and I know we're about to run over, so keep going. Yep.
It's like if you buy stock and later sell it for more, the difference there is key. Let's see, did we answer all, do we have any follow-up scholarship questions? I mean, the general rule is they're not taxable. And then there are a couple carve-outs of that. Did you have a question?
Yeah, does it matter if the organization, since I read both, they send folks with the school and also to educate
Like they like directly deposit it in your
Yeah.
checking account?
Yeah, and then I use that to pay off.
I don't think so.
I think that is for supplies. It will not be
Yeah, I don't think it
taxable.
matters how like you could technically use that for to pay whatever you want, right?
Yeah.
And I think if you use it for other expenses, you're supposed to probably report it as taxable income, but I would say no. I don't
That's
know.
tough. I wouldn't.
Because I had a similar situation when I was in college. I would just get a direct deposit. It's almost like getting a paycheck, put in my, and it was for books and it was whatever, board or whatever.
Yeah, I think you're right.
I don't know. I would just say no, it's not taxable.
But it still
All of that will probably be reported on 1098T, right? Those two forms? Yeah, so it's not like you have to go in your checking account and trace back all the cash. The university will give you a form, and generally it's a 1098T or 1098 something.
To get to 98T.
Yeah, and it will show all of the income that you've received so far for either that scholarship or that grant or what have you. So it's not like you have to independently report it. You're just gonna go
Just use that form.
use that 1098T, drop it into TurboTax, and TurboTax will do its dance, and then it'll appear on the form. And more likely than not, it will be non-taxable. Just answer the questions TurboTax answers. Or step Yep.
So it's more of a personal question, but it might be relevant to others. So under qualified education expenses, would a laptop count for that if it's used for schoolwork, or does that fall outside of it?
So I'm going to give you a bit of homework, right? Right? A little bit of homework for you. I'm pretty sure that would. However, the IRS has an extensive list of items that would and would not be qualified educational expenses. I recommend you just take a gander at it. In most instances, qualified education expenses are those expenses you need to pursue whatever educational endeavor you're pursuing. Right?
You Googled that.
Because even for the credits, like the American Opportunity Credit, which we'll get to, you can take, like your credit is available if you use expenses for, book supplies and equipment.
Right. Supplies and equipment. Check.
Equipment is specifically listed, and so to me, equipment in the world of education credits is a laptop.
I would even consider a laptop supplies.
A laptop is pretty standard. Man.
Yeah.
Now, when they're getting a laptop and 2 tablets, that might be pushing it, right? The IRS always pushes reasonableness when you're taking expenses. If you're being unreasonable or pushing it a little too hard, then you're probably not in the right spot.
Yeah, so just look at the 1098T that you get. That was adjustments, these are a few examples of deductions that you, like if you contribute to an IRA as a deduction, moving expenses if you're part of the military now, that changed. Student loan interest, if you're paying off loans, whatever interest you pay on those loans, you get to take as a deduction. So these are separate from the standard and itemized deductions.
Most of you will be in forbearance though, since you're in school or in graduate programs, for your student loans. So you won't be, if you're not in forbearance, this is definitely a student loan interest deduction. Is something you want to take part of. It's $2,500, and phase out is between 60 and 80,000 for single, and something like 120 and 180 for filing jointly. And if you're paying student loans, the specific service provider will send you information regarding how much interest versus principal you have paid every month.
So this goes back to standard or itemized. So the ones we were talking about, you get regardless. And then that goes into calculating adjusted gross income. Then you get more deductions, which is where you pick one of these two. So itemized is just like a list of a bunch of different types of deductions. And like Paul was saying, if you own a home, a lot of those deductions relate to owning a home. So like paying mortgage interest or property tax, stuff like that. So most of you, like you said, are gonna probably do the standard deduction. So, but that's what it is. You pick one or the other. Any questions on that?
So if your medical expenses are more than 7.5% of your AGI, you can claim it as a deduction.
Correct.
That's a hard one.
Which is
Yeah.
really hard, because that's a lot of money.
Yeah.
Yeah,
So,
and that's only if you
healthcare.
itemize.
And you have to itemize. So if
Right.
you're doing standard, then just forget about all those deductions.
So you're thinking at least your total medical expenses would have to be more than $24,000 or $12,000 to $24,000 if you're joint, right? Because
If they're not.
yeah, to even get any benefit, you first have to pop over that itemized deduction amount. So if you're single, your expenses have to be over $12,000. So what would that amount have to be more than 7.5% of your AGI? So you have an AGI hurdle and then another hurdle to get out of itemized deductions, like, or out of your standard deductions.
So like charitable giving, that's an itemized deduction. So if you're doing a standard, then it doesn't even matter, because
I've had one client out of this, and he had horrible cancer. And was spending hundreds of thousands of dollars for his own personal treatment. So that is the only situation.
I've never seen it actually get to that.
Only situation. Rare, very rare.
Any more questions on that?
I pray none of you ever have to experience. Hey,
Just try to compare the two and see the one which is higher, use that.
It's gonna be standard.
$9,000.
Here's just what the tax rates are and what like the taxable income, so you can kind of guess about, how much money you make and what tax rate you're gonna have.
Yeah, generally speaking, the tax rates are more favorable now after tax reform.
Right.
So we still have the same number of brackets, but the spread of the brackets is different, and the top rate has dropped.
So this is including the deduction, it's just taxable income, or is this just what you make flat with no taxes?
This is after, so you start with gross income, then you take all those deductions, then it comes to taxable income, that's the number you
Try by those tax rates.
yeah. So you can like subtract 12,000, that's the standard deduction. to get here. So this is single, if you're married, filing joint, in the back, this would be the brackets. So it's a little different numbers.
Yeah, and it's a progressive table, right? So what that means is that if all of a sudden you're $1 above one of these thresholds, it's not a cliff. So it's not like, bam, all of a sudden now all of your income is at that higher rate. That would be really unfavorable, right?
Just that $1.
Exactly, so it's progressive. So that's why there's a formula to the right, making sure that it is a progressive tax table, not a cliff.
These are the schedules. Schedule 2 is for the tax, different types of taxes. Schedule 3 credits. The child credits there. More taxes, Schedule 4. Earned income through it.
Yeah, so earned income tax credit, have people heard of this credit? No? Okay, we're not gonna spend too much time on this one. I don't think it'll be super applicable, but we bring it up just in the event that it applies. So this is something that sometimes you hear in the news. It's a refundable tax credit. And so what that means is that if you're eligible for this, and even if you don't owe taxes on your return, the government might actually give you money back, like negative taxes, right? That you might actually be subsidized by the government. So this one's popular for particularly a lot of families that I'll generally consider to be in much lower income tax brackets, right? So you can see the thresholds here. And the amount of credit goes up if you're in a low income tax bracket with a whole lot of children. Like that's the combination to get the maximum out of this, right? So it's practically like a federal government subsidy.
But I mean, in DC, Virginia, and Maryland at 50,000, I think you're right below poverty line. Like it's like at the highest rate there. Like it's
For low.
you're barely surviving with this if you have 3+ kids in this area.
And so one of the challenges with this credit for students in particular is that if you can be claimed as a dependent, right, then you're not eligible for this, right? Because For this top one number of children, 0. So at first, right, if you just looked at this table, we'd be like, oh my goodness, look, my earned income is under $15,000. I don't have any children. Can the government give me $529? That would really make my day, right? And the problem is that one of the requirements is that a person can't be claimed as a dependent. So even now, without that deduction, that exemption deduction, your parents can probably still claim you, legally still claim you as a dependent, even if they don't get a deduction. So because you can be claimed as a dependent, then you won't be eligible for the earned income tax credit, unfortunately. Right, next. Okay, so this is probably a good place to park for a few minutes because I think here there is a lot of room for tax benefits for this audience, right? Because the government provides some really great tax credits for education. So there's two that we wanted to highlight. The first one, the American Opportunity Tax Credit, AOTC, sometimes as people refer to it, is really fantastic. So this one applies to post-high school education. So 4 years of qualified higher education expenses. The credit is up to $2,500. And within that $2,500, 1,000 of that also can be refunded. So you can actually get more money back, right? So it's really fantastic. And you can see that there are some income limits, but these are pretty reasonable, right? So for single people, 80,000 to 90,000, it's not too bad, right? A lot of people can probably still benefit. And married probably joint 160 to 180. Okay, so I think I mentioned, let's go back one. Okay, mentioned before that expenses for this AOTC, right, cover the typical expenses that you would expect, tuition expenses, right? This one also includes the course-related books, supplies, equipment, right, computers. So that's okay. You can use these expenses towards gaining this credit.
Some of those might not be listed on like your 1098
Right.
that you get, so you have to, I spent this much on a computer and I spent this much on books, and maybe add it up yourself.
That's right. So that's a really good point, right? Because if you're working on your tax and you're like, I think I qualify, I'm following the rules in the form, I think I qualify, how do I even compute my $2,500? Your starting point should be the 1098T that Georgetown or whatever university will provide to you, right? In fact, you probably have that already. It probably should have arrived in the mail. So that will have a box with the expenses for tuition. So that should be your starting point, right? Because if the IRS were to ever take a look at your taxes, all you would have to say is, here's my support, here's my 1098T, it shows my expenses that I paid for tuition. And then if you have support for your books, supplies, computers, right? Then you just tally that separately to get to your amount. Does that make sense to everyone? Okay. One thing here just to keep in mind, this is not so much of an issue anymore, but if you, on your own 1040, if you want to take one of these tax credits, then your parents on their tax return shouldn't mark you as a dependent. This shouldn't be an issue, right? Because they don't get a deduction for you anyway. So before, this was one of those, got to run some cost-benefit analysis calculations, right? Is the student better off, right, taking this credit and the parents foregoing that deduction? Or is it better if the parents take the deduction, student foregoing the credit? Indirectly, tax credits here, education
Yeah,
credits.
so my parents claimed me all through college, so they got the exemption deductions. Now, they also got this credit. So I never got this credit. They claimed this credit on their return. So that would still apply now. Right? If they're claiming as a dependent, then they would get this credit from you.
It depends on your parents' personal filing situation too.
If you don't have a lot of income, then
Yeah, that's
maybe
probably
you don't have
better.
that much tax to begin with,
Right.
and you could zero out your, maybe they would benefit to have them maybe you can work out a deal with them to pay you some money on the side.
Right, it's possible, right, because now that the standard deduction is $12,000, right, it's possible that naturally your taxes, your taxable income will start to drop, right, because of the really nice standard deduction. So if your taxes, and then you're gonna be in a lower tax bracket, right? So if your taxes are naturally going to be pretty low, then if you try to claim a credit, which you might otherwise be eligible for, the bang for the buck may not be super great, right? But then if your parents do it, right, then maybe for your family, overall, it's a better tax result for your parents to claim the credit. Yeah. The lifetime learning credit is another credit that is also really good. This one is generally targeted to, I'll call it graduate degrees, right? Because the first one, American Opportunity Credit, is generally for undergraduates. And so for the lifetime learning, the credit is $2,000, right? Big difference is that the lifetime learning is not refundable. It's just not a refundable tax credit. And it's calculated also using the expenses from the 1099-T. But it's 20% of expenses
It's up to you
up
if you
to
want.
$10,000.
I can say something.
So that's how that's computed.
Okay, thank you.
Right, so it's not just dollar for dollar credit. You have to spend $10,000 of tuition and then get, right, 20% of it. And then even for lifetime learning, the expanded definition to cover books and supplies and equipment, that doesn't count for lifetime learning, right? That's just for American Opportunity tax credit. There are some really good IRS publications on these tax credits, right? So this is definitely worth a quick read because, you know, even if it takes 30 minutes or even an hour to go through the IRS publications, I mean, look at the benefit, right, that you can get.
Just Google it and
Yeah.
get a lot of information, because these are really like beneficial.
I mean, I took these when I was in school. I mean, these are the best credits.
Yeah, and these publications help if you're having trouble sleeping. Like, it will put you to sleep. Just thinking about it now, maybe young.
Okay. So we're a little bit over, but I just want to hone in exactly at this one point here. Is everybody familiar with the difference between a deduction and a credit? Okay, good, right? Because I want to talk about this one. So in your tax equation that you have on your sheet, you'll see both referenced. Just remember this. A credit is better than a deduction. So if you're eligible to take a credit, by all means, take the credit and don't take the deduction. The reason that's the case is because if you follow the formula of how taxes are computed, a deduction reduces your income before your taxable income is multiplied by a tax rate. Right? So said differently, a deduction's benefit is tax effective. So if you're in a 20% tax bracket and your deduction is $1,000, you're only getting a $200 benefit, right? 20% of $1,000. A credit is dollar for dollar, so long as you're actually paying tax, unless it's refundable, right? So a $1,000 credit against, right? So if you have a tax liability of $1,000, a $1,000 credit will dollar for dollar reduce that tax liability to zero.
And you can see the difference here, the $1,500 credit versus the
Yeah.
deduction. One results in $500 tax, and one results in $1,800 tax.
Right, because here on the left, the credit is dollar for dollar reduction of your tax liability. Versus on the right side, it's tax effective. Right, you're only getting, if your tax rate is 10%, you're only getting a 10% tax benefit. So that's why the education credits are so awesome. It's a dollar for dollar reduction of your